In this video, I will reveal 8 unique strategies that self-employed individuals can use to reduce their taxes. Number 1, home office expenses. If you're self-employed and work from home, you can deduct a portion of your household expenses. The portion of household expenses that can be deducted is determined by calculating the percentage that the size of your workspace at home is of the total size of your home. For example, Charles is an accountant and works out of his own home. His office space takes up 700 square feet of his 2,800 square foot house. If Charles has office-related expenses that total $25,000 during the year, he can deduct 25% or $6,250. The following household expenses can be deducted. Mortgage interest. The following household expenses can be deducted. Mortgage interest. Property taxes. The following household expenses can be deducted. Mortgage interest. Property taxes. Maintenance and repairs. Condo fees. Utilities, including water, gas, and electric. It is important that you do not claim dual-purpose rooms, such as a bedroom. If you intend to designate a part of your house as part of your home office, it can only be used for the purpose of business activities. Rooms such as a kitchen or bedroom cannot be claimed. The CRA is also asking home office users to submit a floor plan of their house upon audit. This is to make sure. Number 2, pay salaries to family members. Self-employed Canadians save taxes by paying family members a reasonable salary. This strategy works if you, as a self-employed individual, are earning more than your family members. Those earning less than you will be in a lower tax bracket, thereby allowing you to save tax. In fact, the first $11,474 of employment income is tax-free. If your children are not working, you can save taxes in Canada by paying your children $11,474 each. The salary will be tax deductible to you and tax-free for your children. It's important that an employment agreement be prepared that specifies the duties that your family member will be performing and their hourly wage or annual salary. In addition, a weekly log should be kept to support the time spent working by each family member. The reason for doing such things is to ensure that there's a bona fide relationship between yourself and your family members that will help refute any challenges by the Canada Revenue Agency. Let's look at an example. Stefan earns $150,000 a year. His average tax rate is 32.1%, so he owes $48,172 in taxes. Stefan can split his income with his family members to reduce the taxes he owes. Stefan pays his wife Amanda $50,000. Then he pays his 2 daughters, Christy and Rebecca, $15,000 each. This leaves $70,000 of income for Stefan. Now, each family member's income will be taxed at their own tax rates. Stefan's income will be taxed at an average of 21.14%, which equals $14,801 of taxes payable. Amanda's income will be taxed at 17.14%, which equals $8,571 of taxes payable. Both Christy and Rebecca's income will be taxed at only 5.4%, which equals $810 of taxes payable for each. Before incorporating, Stefan owed $48,172 in taxes. After income splitting with his family, the total they owe in taxes is reduced to $24,992. Therefore, Stefan has saved himself $23,180. Number 3, lease a vehicle. Canadians who own their own business can save taxes by leasing a vehicle for their business. The following vehicle costs can be deducted for tax purposes: repairs, fuel, insurance. Canadians who own their own business, the maximum monthly lease amount that can be deducted is $800 plus taxes. Anything over and above this limit is non-deductible. The percentage of vehicle operating costs that can be deducted is calculated as the total kilometers driven for business purposes divided by the total kilometers driven in the year. For example, if you drove 12,000 kilometers for business purposes during the year and 20,000 kilometers in total, then 60% of your vehicle operating expenses can be deducted. Number 4, Keep accurate books. Accurate books and records ensure that all expenses are captured on your business's financial statements and personal tax return. This way, nothing is missed. The best way to keep accurate books and records is to purchase an accounting software program, such as QuickBooks or Simply Accounting. Number 5, incorporate to save taxes. Incorporating your company. By incorporating your company, your business profits will be subject to a very low tax rate of 15%. On the other hand, the business profits of an unincorporated business are included in the owner's taxable income, which is taxed at 53.5% if you're in the highest tax bracket. Incorporating your company will also open yourself to more tax savings opportunities. Number 6, individual pension plan. For individuals who are higher income earners, you may want to invest in an individual pension plan, or IPP. Unlike a registered retirement savings plan, an IPP will allow you to continue living a high-income lifestyle upon retirement. An IPP is a defined benefit pension plan that is registered with the provincial government as well as the CRA. It will provide the investor with the specified monthly pension benefit. The annual contribution amount of the IPP is established by an actuary and is tax deductible. In fact, the annual limit of an IPP could be greater than that of an RRSP. Number 7, health and welfare trust. Another way to save taxes is through a health and welfare trust. This trust is a tax-free vehicle used for your corporation to finance its employees' healthcare expenses. The main step to establishing a health and welfare trust is setting up an account exclusively for the purpose of healthcare spending by employees. Another way to save taxes is through a health and welfare trust. This trust is a tax-free vehicle used for your corporation to finance its employees' healthcare expenses. The main step to establishing a health and welfare trust is setting up an account exclusively for the purpose of healthcare spending by employees. Number 8, multiplying the small business deduction. Another savings tip is the small business deduction. In Canada, Canadian-controlled private corporations, or CCPCs, will pay tax at a rate of approximately 15% on taxable income up to $500,000. This deduction is a major way to save taxes for self-employed individuals in Canada. Thanks for watching. Please remember to like, comment, and subscribe. Also follow us on Facebook and Twitter for more and great tax tips. Thanks and see you next time.